So let me start by giving you the macro picture or big picture. So if you look at India current nominal GDP, we are currently stands at around $3.5 trillion of nominal GDP. And this number is expected to become $7 trillion by 2030. And India will become from fifth largest economy globally to third largest economy globally. So it's a very decent growth, but still India would be a very distant third economy compared to, say, US and China, which will be number one and number two. And it will take us almost around 20 to 23 years to reach the size of the US economy. And what we have seen in case of United States over last 25, 30 years is that their banking assets and their financial assets has grown much faster than their nominal GDP growth. In fact, their financial assets has grown at 1.5x of the nominal GDP growth over last 30 years. And we believe in India also, we will have a far superior growth where the financial assets can grow somewhere between 1.5 to 2x of the nominal GDP growth. And this is something which will drive a very good growth in the overall financial services sector for next decades to come. And what another thing which we have done is we have looked at how over last, say, 25, 30 years, the US economy has shaped up and how their individual household asset mix has changed. So one thing which we have noticed that that equities and mutual fund, their share in individual household assets used to be at around 8.5% about 30 years back, and that share has increased to around 25%. And this gain is something which we have seen across the income group in the United States. And in fact, if you look at the top 10% of the household, equities and mutual fund assets has become the largest asset class in their household assets. So we have seen a very sharp growth in equities and mutual fund and generally the financial assets in the United States over the last 20 to 30 years. Then we try to analyze how this has impacted the capital market. So what we have done is we have looked at the S&P 500 index and look at how the composition of financial services companies have changed. So if we look at the major financial services company in the S&P 500 index about 25 years back, out of the top 15 companies, 10 were lending companies and 5 were non-lending companies. But if we look at current scenario, that has completely changed where out of the top 15 companies, now 11 are non-lending companies and only 4 are lending companies. And if you look at these non-lending companies, this includes credit card companies like Visa, MasterCard, and American Express. This also includes a couple of insurance company and a couple of wealth management and stockbroking companies. So there is a significant growth which has happened in the market cap of non-lending companies in the United States, and they have become far more dominant compared to what was the case, say, around 25, 30 years. And our belief is that a similar thing can really play out in the Indian context also. And if we look at the India's household savings, we are already seeing some bit of this playing out where the share of financial assets has increased from 41% to 46% in last 10 years. And this has come at the cost of physical assets whose share has come down from 59% to 54%. Also, within the financial services, we have seen that share of equities and mutual fund has increased from 2% to around 7% in last 10 years. So again, in the Indian context also, we have seen, firstly, financial assets growing at a slightly faster pace. And secondly, within the financial assets also, share of equities and mutual fund increasing compared to other asset classes. Even if we look at Indian capital market, what we have seen that if we look at, say, top 1,000 listed companies, the number of companies in the lending space has largely remained constant, where the number of companies in the non-lending space has been growing. And this has also resulted into change in the market cap mix, where lending used to form almost 90% of the overall financial services sector market cap. But now they are only 70% and 30% is being represented by the non-lending companies. So we are in the Indian context also, we have seen a significant shift which is happening in the non-lending space. And we again believe that over a period of next 5 years, 10 years, this kind of changes will continue and probably accelerate only. And the reason why we are saying this, that if we look at the drivers of this change, there are 2-3 drivers which we can attribute to. One is the technology. We are seeing a significant technological change which is happening across the globe and which we are all aware of. However, in the Indian context, what is important is what is important is 2 factors. One is penetration of the smartphone. In 2 years' time, we will have 80% penetration of smartphone. Second is that the cost of data is one of the lowest in globally. Hence, everybody who can actually afford the smartphone can actually afford to use internet on their smartphone. And that is one which is a very significant change which has happened over last, say, 5-6 years. And as I highlighted, that smartphone become very, very prevalent, and it will its penetration will be almost 80%. So this is a one big thing which has been changing and which has driven the change over last 4-5 years, and it will continue to drive the change which we have seen. Second important factor is the government initiative. Government has taken quite a few initiatives which has changed the way the financial services are doing businesses. So if you look at UPI, they have virtually replaced the cash in the economy. Then if you look at the eKYC, previously doing the KYC was very cumbersome process, but now with eKYC it can be done online in few minutes. And even if you look at this current budget, the government has been trying to put focus on the central KYC, where you just do KYC once and it can get replicated across all the financial institutions. So you don't really need to repeat the process. So there have been so many initiatives which the government has been taking, and there are so many other things which are already in work and which will bring fruits in the coming years. So the government has been doing a great job in terms of bringing some of these new initiative, which is becoming the backbone of the financial services industry. And the third very important change which is driving this shift is the behavior of the newer generation. If we look at our older generation behavior, they used to be relatively very conservative. When it comes to saving, they mostly used to invest into the physical assets like real estate, gold, and cash. And they were also very averse to borrowing and hardly used to use borrowing for buying things. However, if we look at the newer generation, which is Millennials and Gen Z, they are not afraid of buying things on EMI. And even when it comes to the financial savings, they are increasingly looking at asset class like equities or mutual fund, where the return profiles are much better. And so this is something which is a very significant change. And this generation will become bulk of the population in 5 to 10 years down the line. So this change which we have seen is something which is going to accelerate because of the population mix being changing. So because of all this thing, we are actually very positive on the overall financial services sector. There are 2 sides of the sector. One is the lending area, which includes banks and NBFCs. Within NBFC, we have diversified NBFCs, as well as some of the vertical NBFCs like housing finance NBFC, infra finance, microfinance, gold finance, etc. And on the non-lending side also, we have so many sub-segment like asset management company, depositories, stock broking, ratings, exchanges, etc. So we have so many such segment within the financial services industry, and we believe a healthy blend of this can become a very important as we are moving forward. And if we look at the size of the non-lending companies or some of these segment, they are very small compared to the banking industry. So if we look at the banking segment, the average market cap of banks in India is currently around 2 lakh crore. Now, if we compare this number with the largest company in some of these segment, like say general insurance, the largest company is around 1 lakh crore, which is half of the average market cap of banking. Same is the case with asset management or housing finance company. And then we have companies in wealth management, stock broking, ratings, which are much, much smaller compared to average market cap of bank. But what we have seen in case of United States, where some of these companies over a period of time has become very, very large, in Indian context also, similar story can play out, and we believe some of these will become much larger as we are moving forward. One thing which we have noticed that over last 3 to 4 years, we have seen a significant growth in some of these sub-segments, whether we are looking at demat account or the mutual fund investor. However, if you still look at, say, a number of demat account, they only are 15 crore demat account. The mutual fund investors are only 5 crore, and same is the number for, say, NSE active client. And when we compare this number with our population size, which is around 144 crore, this number looks very, very small, and there is a significant potential for this number to become larger. Second thing to note over here is that even when we compare to other global averages or the United States, our penetration level is much lower. And again, compared to those economies, there is a significant room for us to increase our penetration. So whatever growth which we have seen in last 3 to 4 years is just a starting point, and we believe there is a long journey ahead of us. Coming to the lending side, this is one sector which has not done as good as some of the other sector in last 3 to 4 years. But generally, the health of the system or health of the banks and NBFCs has improved. If we look at the asset quality, the NPAs and the slippages number has been gradually coming down. And on back of that, the return on asset of these companies has improved considerably over the last 4 years. And currently, in terms of even capital adequacy, they are sitting with a very strong equity book where they can fund their growth for next 2-3 years without raising any equities. So overall health of the banking system or lending system has improved significantly over the last 3 to 4 years. And when it comes to valuation, they are currently trading at a valuation which is one standard deviation below their 10-year historical average. So from the risk-reward perspective, these sectors look very, very attractive at this point of time, specifically in the current volatile scenario. And second thing is, if you look at the historical return profile of the sector, they have outperformed the Nifty 50 over a longer period of time. So if you look at, say, 5-year rolling return of BSE Financial Services Index versus, say, Nifty Index, BSE Financial Services have outperformed 72% of the time. And this number increased to 95% if you look at 10-year rolling return. So generally, over a longer period of time, BSE Financial Services Index has done better than the Nifty 50, which indicates that this sector has generally outperformed the broader market. So if we let me give you some specific examples which can be could be a growth drivers in the coming years. If we look at, say, mutual fund industries, if we currently we have seen that over last 10 years, the mutual fund AUM has grown at 21% CAGR, which is a very, very impressive CAGR. However, mutual fund is still forms only 5% of the annual household savings. So if we assume, say, 10% growth in the nominal GDP for next 6 years, and this 5% number, even if it increased by just 1%, what we can witness is that the annual flow into the mutual fund can increase from $30 billion to $70 billion, which is more than 2x growth in the coming 6 years. So we have seen a tremendous growth in the mutual fund inflow by the domestic investors, but we believe that this number is continue to grow over next 5 to 7 years. And hence this entire ecosystem looks very attractive to us from the medium to long-term perspective. Second area is the wealth management. If we look at the population mix, what we are seeing that higher income group are growing faster than the average population growth, and they are becoming bigger part of the population. And most of these higher income group will need the services of wealth management in some way or another. And even if you compare with the global averages, India ultra HNI population is expected to grow at 50% in next 5 years, compared to around 29% growth for the global average. So India HNI population, or generally the higher income group population, is something which will grow at a faster pace. And again, this area looks exciting to us again from the medium to long-term perspective. And third area on the non-lending side is the insurance. If you look at the India health insurance, currently out of the total medical expenditure, 2/3 of the medical expenditures are paid out of pocket. And this is the stark contrast with the global averages, where this number is less than 20%. And even in case of China, this number, where it number is 36%. So this really indicates that there is a significant underpenetration of health insurance in India. And as the economy grows, we expect this number to inch up. Second thing is, even if you look at the life insurance side, India only has 3% life insurance coverage compared to double-digit coverage in most other developed economies. So again, this sector has not done well because of some of the regulatory changes which has curtailed the growth for the sector. But generally, if you look at the underpenetration level, this sector look very, very exciting to us for the next 3 to 5 years perspective. So these are some of the examples on the non-lending side. Let me also give you some example on the lending side also. So one is the key example is of the MSME segment. Even if you look at the current budget, in the current budget, government has trying to focus a lot more on the MSME segment. So about say 4-5 years, about say 7-8 years back, government has launched a Udyam portal where an MSME can register themselves, and after that they can access to the formal channel of credit. So if you look at historically, this segment used to rely on their friends and family for their credit needs. But that is changing, and in the current budget also, the government has tweaked certain norms, because of which more number of MSME will be able to register on the portal, and as a result, they will be able to access the formal channels of credit. And if you see the current lending to the MSME segment, this is significantly lower than the overall potential which is there in the system. So again, this is one area which should see relatively high growth in the coming years. And we are again positive on companies which have a reasonably good exposure to this particular segment. Next segment which we are positive is the housing finance segment. We have seen a very good real estate cycle over last 3 to 4 years. The pre-sale number of real estate companies are still very, very strong. So based on this, we expect that generally The loan growth in the housing finance segment continue to remain robust in the coming years, and they have generally gradually increased. So if you look at mortgage to GDP ratio, it has gradually increased from 8% to around 12.3% in FY23, and expected to increase to around 14 to 15% in FY25. And on base of that, they have shown a steady growth of around 30% over the last 4 5 years. So this is again a one area which could provide a steady and good growth in the coming years. And lastly, one thing which we have noticed in case of bank over the last couple of years is that deposit growth has been the key constraint for the loan growth for some of these banks. And in this scenario, deposit growth again becomes very, very critical for them. And banks which are able to do better execution in terms of mobilizing the deposit growth should have a better credit growth and earning growth in the coming years. And hence, we have seen selectively some banks are doing better than others, and hence we are selectively positive on some of these companies. So these were some of the examples of how, the opportunities in the overall financial services sector. But this is definitely not a very comprehensive list. The list is much longer. We have just given you some examples over here. Now, coming to our fund and how we are approaching to build our portfolio. So, we want to have one segment of companies which are leaders in their categories. These companies have seen multiple cycles and currently a very strong balance sheet. These mostly would be large cap companies. And these kind of company will have relatively lower risk profile, and they will have a substantially good quality balance sheet. So these would form a core part of portfolio where they will provide a steady growth and stability to the portfolio. Then second set of companies would be companies which are maybe relatively small, but they are challenging the leaders and gaining market share because of their superior execution. And again, these are the companies which has been growing much faster than the overall industry, and hence these are the companies which can really provide the growth and the alpha in the portfolio. And then the third set of companies are the new age companies or the fintechs. Again, these are the companies which are either coming up with a new business model or disrupting the way the traditional businesses are being run. And because of that, again, they are showing a very, very high growth. And this is again a very exciting area, and we are selectively looking at this particular segment. So, in terms of our portfolio composition, so if we look at the benchmark, which is BSE Financial Services Index, this is heavily skewed towards lending and large cap companies. So, lending companies has around 81% weight in the index, and large cap companies has around 76% weight in the index. So benchmark is highly skewed. In our portfolio, we will like to have a more balanced approach. As I have highlighted previously, that non-lending companies is something which has been, where there is a better growth, and they will become much larger part of the overall economy as well as the market. And hence, we will like to be overweight on the non-lending space. And hence, our portfolio would be more balanced in terms of lending and non-lending company. And also, if you look at the breakup of non-lending company in terms of market cap, they are more evenly distributed between large, mid, and small cap companies. And hence, and there are a lot many opportunities in the mid and small cap side in the non-lending space. And since we will be overweight on the non-lending side of the market, our portfolio will be more evenly distributed in terms of market cap also compared to the benchmark. So we believe that our portfolio would be more balanced towards both lending and non-lending, and also in terms of market cap. And this will probably reflect the truer picture of the growth which is available in the market currently. And we believe this can really generate alpha over say over medium to long term. So we are really excited about this, and we are trying to differentiate our portfolio compared to the benchmark. We will mostly be bottom up. We will create portfolio mostly from the bottom up approach, where we will be largely benchmark agnostic and look at individual companies and include those companies which make merit, and we will not really include companies just because it is there in the benchmark. So in that case, we believe that we will be able to create a differentiated portfolio, and probably if we will be able to create alpha from our portfolio. So these are some of the sectors which can be there in our portfolio. So this is essentially the key points which I wanted to highlight regarding our portfolio and our approach towards constructing the portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.